Hello guys, this is David, also known as the Spread Doctor, and this is my journal for Friday the 23rd of October. So it appears that the wait and see mode continued in equity markets today, and all the major indices were up just slightly, with the exception of the Dow. The Dow was down, and it was down largely because of Intel. And as you can see here, Intel was down about 10.5%. Intel announced its earnings today, and it reported a 7% drop in the data center revenue, and that caused the stock to sell off by about 10.5%. And that weighed heavily on the Dow, and that is why the Dow was down, but all the other major equity indices, the S&P, the Russell, and Nasdaq were up. They were up by less than half a percentage point, so they weren't massively up. And I think the heat map kind of reflects that. You have some massive big green boxes, some of the ones that were up. Facebook was up 2%, that's significant, but then there were quite a few other ones that offset it. So in balance, we just call it a mixed bag, I would say. So I was thinking, what direction is the equity market heading overall? Are they going to be going up or going down? And I saw a very interesting interview today. The CIO of BlackRock, which is one of the largest funds in the world. The CIO of BlackRock's fixed income unit with a fund size of $2 trillion with a T, $2 trillion assets under management. He stepped up to the plate and he made a very bold call on the equity markets. He said that he sees equity markets going significantly higher from here. And what I found refreshing about this interview is that this guy is not an equity guy. His name is Rick. He's not an equity guy. His business is fixed income. But he analyzed the equity market through the lens of a fixed income analyst. So equity analysts tend to focus more on the PE ratio multiples, the price earnings, for valuation purposes. But Rick decided to use a different metric. He used metric that he uses to analyze the fixed income and the lending business, and he focused on the free cash flow. The main premise for his bold call is that the Fed has made the fixed income market and the agency mortgages market uninvestable. And this is coming from a guy who has $2 trillion to invest or already invested in these fixed income markets. With interest rates as low as they are, pretty much zero or less than, the 10-year treasury is yielding less than 1%. With the interest rate so low, the earnings on fixed income assets are very, very low in comparison to equity. And Rick said the equity markets are yielding about 4% annually on their free cash flow, and that goes well into next year's earnings. On the other hand, the fixed income is yielding 0 to below 1%, and this makes the equity markets very interesting. Very interesting, even for a guy whose mandate is to invest in fixed income assets. So he sees the free cash flow on the balance sheet as a better metric than the PE ratio that the equity guys tend to look at. He sees the free cash flow as a better metric because it kind of indicates that this free cash flow can be used on capex, on capital expenditure. It could be used to buy stock, or it could be used for expansion. And this is regardless of whether the company has a high PE ratio or a low PE ratio. And he sees the equity markets going up by as much as 8% next year. And on top of the free cash flow, if you factor in the fiscal and the monetary policy expansion that is about to be unleashed, or to be unleashed sometime soon, you have a catalyst to propel the market higher. So about 2 trillion of fiscal and monetary policy stimulus is going to be injected into the economy, and that is regardless of who wins the election, whether it's a Republican or Democrat. They need to pump this money into the market to stimulate it. And with the fixed income markets looking very unattractive, the equity market could very well be the big beneficiary of that stimulus. And that's one of the reasons, or the main reason, why a lot of commentators are still very bullish on the equity markets. Rick also talked about an ongoing super cycle in the technology sector. He alluded that companies are innovating very quickly in comparison to how the dot-com companies were innovating at the time. He said they're able to execute at scale because borrowing costs are very low, and many of them are achieving positive cash flow from the outset. And he sees more cash inflows into the technology space. But the one thing he couldn't pin down is time. But then when you look at most of the big macro calls, they tend to be long-term views, and timing is often very difficult to predict at the macro level. So I think one has to drill further and determine the timing based at the micro level, not the macro level. So I found his call interesting, very intuitive as to why he believes the market should go higher. But then it's a stock picker's market. You need to pick your individual stocks and drill down to the micro level. So I just thought to mention that. The VIX. The VIX was down slightly today, closed at 27.55. So again, still above 20. I mean, it's been above 24 going on 3-4 months now. It's found a permanent residence above 20. But the VIX futures, however, are pricing in higher volatility in November. So the November VIX futures is quite high, and there's a slight drop-off in the December VIX futures. That said, I had no new trade ideas today, and there are now 27 days until the November contract expires. I'm going to move on to my open positions. So I have got 2 open positions and 1 synthetic position. I have an open position in ARKK and an open position in SLV. I have a synthetic position in TAN. I couldn't get a fill on this trade idea, but somebody did get filled at 110, so I'm going to cover it like a real position. Starting with ARKK. ARKK, I sold the 110-115 call for a credit of $1.04. At the end of week 1, let me see where ARKK closed. So at the end of week 1, ARKK closed at 99.18. My 110 short call strike is currently out of the money and no action is required on this one. Moving on to the next position. Actually, before I move on to the next one, ARKK, so my short strike 110 is out of the money, and at the end of week 1 the position is showing a positive P&L of $65 per contract. If I go to my portfolio tab here, so ARKK is currently showing a P&L of positive P&L of 325. I've got 5 contracts, and that works out to be $65 per contract. My second open position is in SLV. On this one, I sold the 22.19.5 put spread. I received a credit of 52 cents. Let's see where SLV closed. SLV closed at 22.94. My short 22 put strike is out of the money, and the position currently shows a small negative P&L of minus $4 per contract. My short strike 22 is still out of the money and no action is required on this position. And the third and final one is in TAN. On TAN, we sold the 80-85 call spread for a credit of $1.10. So TAN closed at $71.12. The short 80 call strike is out of the money. No action required. And in terms of the P&L on this one, I haven't got a position, but sold it for 110, and I sold the 80 and bought the 85 call spread. Let me just see where the mid price for that spread closed. So this is for TAN. I'm going to go to my trade tab, and we sold the 80 call and bought the 85 call. So the mid is currently, or the mid closed at 102, sold it for 110, and that works out to be a positive P&L of $8 per contract. The short 80 call is currently out of the money, so no action is required on this one. TAN is an ETF linked to the solar green energy sector. And it's worth noting that after yesterday's US presidential debate, most of the solar energy sector, or green energy in general, they rallied hard today. But TAN, this stock has had such a massive run up since March, and it did not participate in today's massive rally up. I think that bodes well for this position. It's out of the money, but as you've seen in most of our positions, things can change overnight. But given that the ETF, the solar sector or the green energy in general, rallied hard today, this one did not. And again, that underscores why I wanted to get a fill in this position, because it has had such a massive run up. And the thing is, because a friend pinged me and he was asking me, oh, so, you know, solar sector is bullish, this stock is going up, why aren't you selling a put, why are you selling a call? It should be going up. And I said, yeah, you don't get me wrong, I'm not making a long-term call here. This is not a macro view, this is trading. It's a 30-day trade over the next 30 days. I mean, this thing has had a massive run up. You know, the way I see it, it's more likely to consolidate. I'm not saying it's going to go down massively or fall off the cliff, but I see either going down a bit and consolidating before going back up. And when you look at the probability, I'm saying I think over the next 30 days, there's a high probability that this thing is going to either stay within a range or go down a little bit before it goes higher, maybe in December or January. So that's that's how I think about these positions, not saying, oh, this thing is bullish, so I have to sell a put. No, that's not how I see things. Anyway, that brings me to the end of my journal for today. I am going to skip the watch list because I'm not. My window of opportunity for November is closed. I might put on a watch list on Monday, but I'm going to skip it today. And the main highlights for today are all the three positions are working fine. None of the short strikes is in the money. They're all out of the money. And a well-respected fixed income fund manager made a bold call that the equity markets are going to go higher. I hope you enjoyed listening to my journal. You can leave me a question or any comments below, and have a fantastic weekend. Goodbye.